Welcome to Taking Stock for the week ending the 26th of November 2021, where today Matthew Swartz, our Senior Portfolio Manager in the Lincoln Managed Funds team, and myself, Kien, Trinh, stream to you all things share market. Thanks for joining us today, Matt. And interestingly, the US market has been outperforming our market. And this has come on the back of a solid third quarter reporting season with 82% of companies beating earnings expectations, well above the 5-year average of 76%. And at the sector level, healthcare and tech have the highest percentage of S&P 500 companies beating estimates, while materials and utilities have lagged. And this can be seen from the sector chart on screen, with tech and healthcare sectors showing the largest proportion of stocks beating expectations, and that's highlighted in green. Also, the weakest sectors with the highest proportion missing expectations are materials and utilities in red.
And Kien, the S&P 500 index has a much higher concentration to growth sectors, with tech and healthcare collectively making up about 42% of the overall index. So this better than expected reporting period, particularly in those segments, combined with strong underlying trendline and earnings momentum, explains for the most part why the US market is outperforming the Aussie market. As we know, the Aussie market is far more concentrated in cyclicals such as banks and mining stocks. So the Lincoln US Growth Fund has similarly experienced a very strong period for the unit holders. The fund's overweight exposure to tech, consumer stocks and healthcare, as shown on screen here, has contributed to the above market performance in recent months. Now, on a stock-specific perspective, there's been some incredible contributions from some of our tech holdings, such as Enphase Energy, up a whopping 67% over the quarter, and Arista Networks and chipmaker Qualcomm are up similarly, up a spectacular amount, nearing 50%. Now, on the consumer front, Etsy led the way as the online marketplace platform continues to experience some rapid growth. More locally now, there has been some strong support for our tech and healthcare stocks, which have in part benefited from a 5% decline in the Australian dollar relative to the US over the month. Now, remember, stocks like CSL, ResMed, Fisher & Paykel, Cochlear and Altium generate a large portion of their revenue overseas, so they do benefit from the stronger US dollar. And this currency dynamic is also providing some strong footing to the resources stocks because commodities are ultimately priced in US dollars. Now, on top of that, there are some indications here that Chinese authorities are starting to relax credit conditions and intending to boost investment in construction in an effort to counter their overall slowing economic growth. And this emerging development has led to some price support this week for star income stocks BHP, Rio and Fortescue, which have ultimately experienced some significant negative earnings revisions over the last 3 months on the back of that falling iron ore dynamic. Now, although the enormous dividend yields these companies have produced in recent times ultimately cannot be sustained, they should continue to provide an attractive dividend yield to investors well in excess of the current market yield. Look, there are a lot of moving parts when it comes to China, so you should always tread carefully, and that's exactly what the income fund is doing. We prefer the relative safety of the majors and continue to hold all three.
And Matt, over the last few weeks, we've seen a mean reversion in international freight or shipping costs, as denoted by the Baltic Dry Index on screen. And during the last reporting season, there have been concerns about inflationary input costs and the wind down of inventory levels, especially among the importers. But this appears to be a transitory issue for now. Some of our star stocks to benefit include the retailers such as JB Hi-Fi, Premier Investments, Accent Group, Lovisa, Breville Group, and also building materials like James Hardie as well. But speaking about the retailers, over the week, star growth stock and fast fashion retailer Lovisa Holdings, they were sold down after releasing a seemingly positive trading update, with same-store sales up 25% for the first 20 weeks of financial year 22, and that was helped by the reopening of stores following COVID lockdowns. But consensus earnings expectations have been revised lower over the last 3 months as analysts anticipate a slowdown in its new store rollout strategy due to the logistics delays and also shortages of store building contractors. Now, despite this, there was further share price weakness in this stock, and that could represent opportunity to gain exposure to a stock that should continue to benefit from the reopening theme and also the upcoming strong holiday trading period.
And Ken, earlier we spoke about the recovery in healthcare stocks on the back of this falling Australian dollar dynamic. And this week, borderline star growth stock Fisher and Paykel Healthcare released its first half result. This particular business, New Zealand business, develops products to treat respiratory care and sleeping disorders. Now, earnings came in well above market expectations, pleasingly, because it's a position that we hold in both the income and growth funds. And this has come on the back of renewed COVID-infected patients boosting hospital demand for its consumable products, which are ultimately related to ventilator usage. Now, growth in consumables appears to be accelerating, and it was up 24% for the period. And even more positively and consistent with what Cam was talking to with regards to shipping, that shipping chart earlier, management expects supply chain pressures such as freight costs to ease. Now, although there was no formal guidance provided, we do expect that analysts will revise their earnings expectations higher for the full financial year 2022.
Yeah, that's a positive company. And another company to report its results, Matt, was Technology One, T&E's the code, a company here that develops software to help companies, especially those in government, to manage their billing, payroll, and performance management. The full year result revealed an 8.6% rise in annualized earnings, and that was driven by increasing customers converting to software as a service, taking advantage of this structural shift to the cloud. And this allowed the company to maintain its high net profit margins at 23%. Unfortunately, we've had to remove the stock from borderline star growth stock status because its annualized return on equity fell from 58% to 44% over the half. And the drop in earnings efficiency was partly driven by the 14% rise in its cash balance, which led to a higher equity base, presenting a cash drag to its profitability.
Yeah, Ken, the underlying result didn't appear to be too bad, but the negative share price reaction was ultimately really a function of very high expectations built into the share price, with the stock being up near enough to 35% for the year to date. That double-digit earnings growth is expected to materialise in the coming year, and this may result in the research team revisiting the stock in the near future. Now, for income investors, shareholders have now voted in favour of the takeover for Spark Infrastructure. Now, with a tick from the Foreign Investment Review Board and shareholder approval, the group is now finally awaiting the final approval from the New South Wales Supreme Court, with the hearing expected to take place actually today. It is expected that Spark will be suspended from the ASX on the close of trade on the 29th of November, and the takeover scheme will be implemented on the 22nd of December this year. Shareholders are to receive about $2.88 a share. For those looking for alternative income stocks, please refer to the Under the Microscope section in last week's Taking Stock video on the 19th of November.
And turning our attention now to the week ahead, the AGM season has officially wrapped up for our star stocks, with only Collins Foods reporting their interim results on the 30th of November. Meanwhile, Aristocrat Leisure, they will be going ex-dividend next week. And those who are trend sensitive can use the SD Max, which is the Stock Doctor Moving Average crossover, or the SD30 TSR, the 30% stop loss or gains from its highs or lows. For highly trend sensitive investors, Smart Group turned bearish on the SD Max this week. Meanwhile, we had several bullish SD Max signals, starting with Wesfarmers, Jumbo Interactive, James Hardie, CSL, and Coles Group. And finally, for those utilising the SD30 TSR, Accent Group signalled a re-entry, while Adairs and Ansell indicated an exit. This week, we put the spotlight on star growth and star income stock, Pinnacle Investment Management. Now, Pinnacle is an investment group that holds ownership stakes in boutique fund managers, which are also known as affiliates. In exchange for providing low-cost fund administration and distribution services, Pinnacle receives a share of the affiliates' management and performance fees. And the unique structure enables investors to gain exposure to a diversified range of well-performing Australian fund management firms across various asset classes, such as equities, credit, infrastructure, and more recently, private equity, following its acquisition of a 25% stake in 5V Capital.
Yeah, that's right, Ken. And one of the key attractions for private equity as an asset class for Pinnacle is the relative stability of the management fees that you get from the value of funds under management, because the unlisted space is not so much exposed to bouts of market volatility like the listed space that we operate in. So Pinnacle will accumulate about 1.1 billion in funds under management from this transaction, which represents only about 1% addition to the group's overall funds under management.
And Pinnacle will be funding the acquisition of 5V Capital via a 105 million equity raise, which suggests a 3% dilution to its existing shares. However, earnings contributions from 5V should comfortably offset any dilutionary impact, with management anticipating a broadly neutral earnings contribution from 5V in the interim. In addition, earnings growth is tracking ahead of expectations for 12% growth, with its funds under management 30% higher than in financial year 21. Longer term, you've got performance fees from this acquisition, which will contribute to its earnings, although private investments typically take about 5 years before gains are crystallized.
And it was a more interesting week for Pinnacle, sort of having observed it as positions in both of our Australian Growth Fund and Income Fund. We saw the share price come off quite meaningfully post the acquisition, which was a bit of a surprise. And we think that the catalyst for that was actually through one of the directors, Adrian Whittingham, selling his stake in the company down 28%. And the reason behind the sale wasn't necessarily disclosed. But Adrian's stake in the business is only about 1%, so it's relatively small. So we do not view this as a potential red flag or flagging a deterioration of the overall business conditions. In fact, Managing Director Ian McEwen continues to hold a significant stake in the business at about 10%.
And following our recent improvements to the Stock Doctor platform, a useful question this week is, how can investors use consensus price targets to help drive stock selection decisions? Well, under Golden Rule 5, the consensus price target is the median of the consensus analyst estimates on where the price is likely to be in 12 months, and is used by most investors as a valuation gauge. However, consensus price targets often change, and our research suggests investing in undervalued stocks based on consensus price targets lacks any predictive power. In fact, investing in steeply discounted stocks on this metric is a high-risk strategy because there are usually reasons why a stock is cheap. It's important for investors to understand these risks before making an investment decision, because cheap stocks can become cheaper later on once these active risks are realized. And this phenomenon is often referred to as a value trap.
It sure is. And although we don't find consensus price targets useful in an absolute valuation sense, assessing the trend of the price target can help us make better stock selection decisions. Similar to forecast earnings revisions mentioned in the Taking Stock video last week, our research has shown that investing in stocks with positive changes to consensus price targets over 3 or 6 months, and also selling or avoiding stocks with significant negative price target revisions can actually help to add improved portfolio returns. Now, under Golden Rule 4, you can view the trend in consensus price targets by clicking on the price target button at the top. And the fund team finds revisions quite useful, particularly for our growth strategies, and thus we actively use this signal as part of our overall quantitative stock selection process.
And many quality stocks tend to trade at a premium, so sometimes it's necessary to pay up for quality. Thanks, Matt, for your insights today.
No, thanks again, Ken, and it's a pleasure being with you.
And the stronger US market performance relative to the Australian market suggests that it could be beneficial for clients to have some exposure to US stocks in their portfolio. And what better way to do this than to look at the Lincoln US Growth Fund, Matt?
Well, I couldn't agree more with you on those sentiments, Kien.
Yep. And also make sure you take advantage of some of the enhancements to Stock Doctor, such as using the trend in consensus price targets to help you select or avoid stocks. Take care and have a happy, healthy, and prosperous week, everyone.